Okay, so when I say the word Nvidia, what's the first thing that comes to mind? For most people, it's that soaring stock price, right? But that's just one story. There's a second, kind of hidden narrative, one that explains why the world's most cautious investors are quietly buying into the company. Let's break it down.
Right, so before we can get to that hidden story, we have to start with the one everybody sees in the headlines, pretty much every single day. For most of us, seeing this logo is like a trigger, isn't it? You immediately think of explosive growth and a high-flying stock that's just gone to the moon. It's a story that's all about volatility and excitement, this wild roller coaster ride that captures the market's imagination with the promise of just massive returns.
Yeah, it's a story of big moves, big swings, and big potential rewards. And look, this high-risk, high-reward narrative makes for great headlines, but it's not the only story. What if I told you there's another group of investors out there who aren't looking for that kind of excitement? In fact, they actively run from it. They're asking a totally different question. In a volatile world, where do we find reliability?
To answer that question, you have to understand that not all money is playing the same game. In the market, there are broadly two kinds of capital, each with a fundamentally different goal.
So, on one side, you have growth-seeking capital. Think of this as the money chasing the next big thing, totally willing to ride the market's waves for a shot at huge gains. And then on the other side is conservative capital. Its goal isn't to get rich quick, it's to stay rich by preserving its value and generating steady, predictable income. So, who is this conservative capital? Well, we're talking about the titans of the financial world. Pension funds that need to pay retirees for decades, insurance companies that have to be able to cover claims no matter what. These institutions don't need excitement, they need absolute rock-solid consistency. So, if these two types of capital have completely different goals, it only makes sense that they use different tools. And this brings us to the fundamental difference between buying a stock and buying a bond.
Think of it this way. Buying a stock means you're buying ownership, a piece of the company's future potential. But buying a bond, well, you're acting as a lender. You're basically giving the company a loan, and in return, you get predictable interest payments. And here's the crucial part. If things go wrong, you get paid back before any of the owners do. So the crucial point here is this. Neither is inherently better. They just serve totally different purposes. Stocks are designed to capture that upside potential. Bonds are designed for survival and steady income.
All right, so let's bring this all back to Nvidia. Why would this survival-focused, conservative capital lend money to a company famous for stock market hype? This is where the second story really begins. Because these investors, they look right past the fluctuating stock price to the core business itself. And what they see is a company that isn't just part of a trend, it's becoming essential infrastructure. Nvidia is at the heart of AI, data centers, and modern computing. You know, these aren't fads, they're the foundations of our economy. And this right here is the key insight. Bond investors ignore the daily news cycle. They care about one thing: balance sheet strength. They ask a simple, kind of brutal question. Does this company generate enough cash and have enough assets to pay back its debts, no matter what happens in the stock market? For these large institutions, Nvidia's bonds offer a really strategic advantage. It's a way to get exposure to the single most important tech revolution, AI, without having to ride the roller coaster of the stock market. You get to participate in the story, but with a safety net. To truly understand this, you kind of have to adopt their mindset. You know, a pension fund manager's greatest fear isn't missing out on a 30% stock rally. Their greatest fear is being unable to send a monthly check to a retiree who depends on it. Their goal isn't just growth, it's solvency. So what does all this mean for the rest of us? The lesson here isn't just about Nvidia. It's about a universal principle of smart investing: using the right tool for the right job. The most common mistake investors make isn't picking the wrong company. It's picking the right company, but using the wrong tool for their personal goal. They'll use a growth-seeking tool like a stock when what they really, deep down, need is stability, or they do the opposite. Smart investing can really be distilled into this simple, strategic process. First, be brutally honest about your goal. Then, choose the appropriate tool. And finally, make sure they are perfectly aligned. It's about building a strategy, not just chasing what's popular. And that brings us full circle. The reason the story of Nvidia's bonds is so powerful is precisely because it's not exciting. It represents the quiet, risk-aware, long-term thinking that actually builds durable wealth.
If you take away just one thing, let it be this. Stocks often chase headlines, riding the waves of news and sentiment. Bonds, well, they're designed to quietly compound, focusing on the slow, steady accumulation of value. Different tools for different purposes.
And so the ultimate question this leaves us with isn't about Nvidia or even stocks versus bonds. It's a question for you. Are you speculating on what might happen next, or are you building a real strategy that's actually aligned with your goals?